Topic: Financial reporting for post-employment and share-based compensation plans. A common criticism of using stock options as a form of executive compensation is that they can lead to unintended managerial behavior. Which of the following statements best describes a potential negative outcome of granting stock options? A managers may become overly focused on short-term accounting earnings to meet performance share vesting conditions, neglecting long-term strategy. B, the potential for unlimited upside with limited downside may incentivize managers to pursue excessively risky projects. C, the immediate vesting of stock grants can cause a significant cash outflow, negatively impacting the company's liquidity. Correct answer: B. Stock options inherently have an asymmetric payoff structure. Managers benefit significantly if the stock price rises above the exercise price, unlimited upside, but their loss is limited to the value of the options if the stock price does not rise, limited downside. This structure can encourage managers to take on higher risk projects in hopes of achieving large stock price increases. The prospect of substantial personal financial gain may outweigh the potential negative consequences for the company, leading to decisions that prioritize short-term stock performance over long-term stability and growth. The curriculum specifically highlights this risk, noting that options can incentivize excessive risk-taking due to their skewed payout nature. A, incorrect. This statement is more relevant to performance shares, which are a type of equity compensation tied to specific performance metrics, such as accounting earnings. While short-termism can indeed be a concern with performance-based compensation, it does not directly address the unique risk-taking incentives associated with stock options. Stock options are primarily tied to stock price movements rather than specific accounting metrics, making this answer less relevant to the question about stock options. C, incorrect. This statement is incorrect for several reasons. First, stock options do not typically result in an immediate cash outflow for the company. They represent a future potential obligation that only materializes if and when the options are exercised. Second, the question specifically asks about stock options, not stock grants. Stock grants, such as restricted stock units or RSUs, may involve a cash outflow if settled in cash upon vesting. But this is not the scenario described. Third, even in the case of stock grants, immediate vesting is uncommon. Most equity compensation plans include vesting schedules that stagger the award over time, reducing the immediate impact on liquidity. Stock options are a non-cash form of compensation at the grant date and do not directly impact liquidity in the manner described. When a company's board of directors designs an employee compensation package, which of the following is a primary objective for including a share-based component, such as restricted stock units, RSUs? A, to minimize the compensation expense reported on the income statement. B, to align the interests of employees with those of the company's shareholders. C, to ensure that management's interests are prioritized over other stakeholders. Correct answer: B. Share-based compensation, like RSUs, gives employees a stake in the company's future success. When employees own shares or have rights to future shares, their personal financial gain is tied to the company's stock price performance. This creates an owner's mindset where employees are motivated to make decisions that enhance long-term shareholder value. Vesting periods, common with RSUs, encourage employee retention and focus on sustained success rather than short-term gains. The goal is to reduce the agency problem, conflict between managers, employees, and shareholders, by making their interests more compatible. A, incorrect. Under accounting standards, share-based compensation must be recognized as an expense. The fair value of RSUs, or stock options, is estimated at the grant date and expensed over the vesting period. This expense often represents a significant cost on the income statement. The purpose of share-based compensation is not accounting-driven but strategic, focusing on employee alignment and retention. Attempting to minimize reported expense would contradict the need to provide meaningful, value-aligned compensation. C. Incorrect. The intent of share-based compensation is alignment, not prioritization of one group over others. While executives often receive larger equity awards, the design aims to make them stewards for all shareholders. Compensation metrics, like total shareholder return, explicitly focus on long-term value creation for everyone. Prioritizing management would likely lead to poor governance, short-termism, and conflicts with other stakeholders, customers, employees, suppliers. Sound corporate governance seeks balance, not hierarchy of interests. Which of the following statements regarding the financial reporting of share-based compensation is most accurate? A. The compensation expense for a stock grant is based on the stock's market value at the end of the vesting period. B. A key advantage of share-based compensation is that it requires no cash outlay and therefore is not recognized as an expense. C. The fair value of employee stock options is estimated at the grant date and recognized as an expense over the service period. Correct answer, C. Accounting standards require companies to measure the fair value of share-based awards, like stock options, at the grant date, not the vesting date or any other date. For stock options, fair value is typically estimated using option pricing models, such as Black-Scholes, that consider factors like stock price, exercise price, expected volatility, risk-free rate, and expected life. The estimated fair value is then recognized as compensation expense on a systematic basis, usually straight line, over the service period, which is generally the vesting period during which employees must remain employed to earn the award. This approach matches the expense recognition with the period in which employees provide service, ensuring proper alignment of costs with benefits. A. Incorrect. For stock grants, including restricted stock units, compensation expense is based on the fair value, market value, of the shares at the grant date, not the end of the vesting period. Subsequent changes in the stock price after the grant date do not affect the total compensation expense recognized. The expense is allocated over the service period, vesting period, to match the period during which employees earn the award. Using the end of vesting value would create inconsistencies in expense recognition and fail to properly align costs with the service period. B. Incorrect. While share-based compensation does not require an immediate cash outlay, it must still be recognized as an expense on the income statement. Accounting rules explicitly require companies to measure the fair value of equity awards at the grant date and recognize this value as compensation expense over the service period. The non-cash nature is an operational advantage, preserving cash, but it does not exempt the awards from expense recognition. Failing to recognize this expense would overstate earnings and misrepresent the company's financial performance. The offsetting entry for the compensation expense is typically additional paid-in capital, reflecting the equity impact. XYZ Corporation granted 25,000 restricted stock units, RSUs, to employees on January 1, 2024. The RSUs vest equally over a 4-year period. The company's stock price on the grant date was $52 per share. What is the total compensation expense that XYZ Corporation will recognize for these RSUs in its fiscal year ending December 31, 2025? $325,000. B. $650,000. C. $1,300,000. Correct answer, A. Total compensation expense equals number of RSUs times grant date fair value. Total compensation expense equals 25,000 times 52. Total compensation expense equals 1,300,000 total compensation expense over 4 years. Since the RSUs vest equally over 4 years, the annual expense is 1,300,000 divided by 4, which equals 325,000. Annual expense equals 1,300,000 divided by 4 equals 325,000 per year. The fiscal year ending December 31, 2025 is the second year of the vesting period, so the annual expense recognized for that year is 325,000. Cumulative expense recognized by end of 2025. 2024 expense 325,000, 2025 expense 325,000 total cumulative through end of 2025 equals 650,000. The total compensation expense is based on the fair value of the RSUs at the grant date. The expense is recognized evenly over the vesting period, 4 years in this case. The question asks for the expense recognized in a specific fiscal year, not the cumulative or total expense. Understanding the difference between annual expense and cumulative total expense is crucial for answering correctly. A company's financial statements note reveals an unrecognized compensation cost of $480 million related to non-vested stock options as of December 31, 2023. The cost is expected to be recognized over a weighted average period of 2.5 years. What is the approximate amount of compensation expense the company will report in its fiscal year 2024? $192 million. B. $240 million. C. $480 million. Correct answer: A. Total unrecognized compensation cost must be recognized as an expense evenly over the remaining vesting period. Total unrecognized compensation cost as of December 31, 2023, $480 million. Weighted average remaining vesting period 2.5 years. Annual compensation expense equals $480 million divided by 2.5 years equals $192 million per year. Since 2024 is the first year of this 2.5-year period, the expense recognized in 2024 is $192 million. This follows the straight-line method of expense recognition, which is standard for share-based compensation, non-vested stock options. Always identify whether the question asks for total cost or annual expense. Pay close attention to the vesting period provided, in this case, 2.5 years. Remember that share-based compensation is typically recognized on a straight-line basis over the vesting period. At the end of its fiscal year, a company's defined benefit pension plan has a present value of the pension obligation of $85 million and plan assets with a fair value of $92 million. According to the reporting standards for defined benefit plans, what will the company report on its balance sheet? A pension asset of $7 million. B. A pension liability of $85 million and a separate pension asset of $92 million. C. A pension liability of $7 million. Correct answer: A. Both IFRS and US GAAP require recognition of the funded status of a defined benefit plan on the balance sheet. Funded status equals fair value of plan assets minus present value of the defined benefit obligation, PBO. Overfunded plans. If plan assets exceed the pension obligation, the plan has a surplus, and the company recognizes a net pension asset. Underfunded plans. If the pension obligation exceeds the plan assets, the plan has a deficit, and the company recognizes a net pension liability. Funded status equals fair value of plan assets, present value of the defined benefit obligation, PBO. Net funded status equals 92 minus 85 equals 7 million, surplus. Since the plan is overfunded, the company reports a net pension asset of 7 million. Only the net amount, funded status, is reported semicolon. Assets and obligations are not presented separately. This approach increases transparency by directly showing whether the pension plan adds to or reduces the company's net worth. The following data is extracted from a company's defined benefit pension plan footnote. Present value of pension obligation, $4.2 billion. Fair value of plan assets, $4.9 billion. Estimated pension obligations, undiscounted, $5.5 billion. The net pension item on the company's balance sheet is closest to A. $0.7 billion asset. B. A $1.3 billion liability. C. A $0.7 billion liability. Correct answer A. Companies must report the net funded status of defined benefit pension plans directly on the balance sheet. Funded status equals fair value of plan assets minus present value of pension obligation. This creates either a net pension asset if overfunded or a net pension liability if underfunded. Only these two values matter for balance sheet recognition. Nothing else. Present value of obligation is used, not undiscounted amount. Accounting standards, both IFRS and US GAAP, require present value because it provides a more accurate measure of the current obligation. The undiscounted amount shows total cash that will be paid out in the future, but ignores timing, making it irrelevant for current financial position. Undiscounted obligation is disclosed but not used. The undiscounted obligation, in this case, $5.5 billion, is provided as supplementary disclosure information only. It helps users understand the total magnitude of future benefit payments without the effect of discounting. It is never used in calculating the balance sheet asset or liability. Using it would overstate the obligation because it treats all future payments as if they were due today. If plan assets are greater than PBO, report a net pension asset. The plan is overfunded. If PBO is greater than plan assets, report a net pension liability. The plan is underfunded. In this case, $4.9 billion assets minus $4.2 billion obligation equals $0.7 billion asset. The company has more resources set aside than it currently owes in present value terms. A company sponsors a defined benefit pension plan. During the current year, the plan's actuary revised assumptions about employee turnover and mortality rates, resulting in a $3 million increase in the pension obligation. Under US GAAP, how will this actuarial loss be reported in the company's financial statements? A, recognized immediately in profit or loss in the current period. B, recognized in other comprehensive income and amortized to pension expense over time. C, deferred and recognized in profit or loss when employees retire. Correct answer, B. Actuarial gains and losses are the changes in actuarial assumptions, like discount rates, mortality rates, employee turnover, or salary growth. The differences between expected and actual experience, actual returns versus expected returns, actual demographics versus assumptions. Increase the pension obligation by $3 million is an actuarial loss because the obligation went up, meaning the company owes more than previously estimated. Actuarial gains and losses are not recognized immediately in profit or loss under US GAAP. They follow a two-step process, first to OCI, then amortized to pension expense over time. This creates a smoothing mechanism that prevents earnings volatility from assumption changes. The economic loss exists immediately, but its impact on reported earnings is spread over multiple periods. Year 1, $3 million actuarial loss recognized in OCI increases pension liability, reduces equity via AOCI. Years 2 to 10. If the loss exceeds the corridor, a portion is amortized each year into pension expense. Each year's amortization reduces AOCI and increases pension expense in profit or loss. Eventually, the entire $3 million flows through to profit or loss, but spread over multiple years. Understanding the corridor approach creates a tolerance band, the corridor equal to 10% of the greater of beginning PBO or plan assets. Only actuarial gains or losses outside the corridor are amortized. If cumulative unrecognized gains or losses are within the corridor, no amortization is required. This further smooths the impact on earnings by ignoring small fluctuations. Under IFRS, actuarial gains or losses, called remeasurements, go to OC, but are never amortized to profit or loss. Under US GAAP, actuarial gains or losses go to OCI and are amortized to profit or loss over time. Under IFRS, which of the following components of a defined benefit pension plan's cost is always recognized in profit or loss in the period it is incurred? A. Actuarial losses arising from a change in the discount rate assumption. B. The net interest cost accrued on the net defined benefit liability. C. The difference between the actual and expected return on plan assets. Correct answer, B. Under IFRS, defined benefit pension costs are divided into three components. Current service cost is the increase in pension obligation from employee service during the current period. Past service cost is changes in obligation from plan amendments affecting prior service periods. Net interest cost is the financing cost calculated by multiplying the net defined benefit liability or asset by the discount rate. These represent the core operating and financing costs of maintaining the pension plan. Components are split between profit or loss, P&L, and other comprehensive income, OCI. This separation distinguishes operating or financing costs from volatile remeasurement effects. Service costs and net interest to P&L, remeasurements to OCI. Net interest cost is always recognized in profit or loss in the period it accrues. Net interest cost equals beginning net defined benefit liability, or asset, times discount rate. If there's a net liability, it means net interest expense increases pension cost. If there's a net asset, it means net interest income decreases pension cost. Net interest cost calculation uses the same discount rate for both the obligation and plan assets. Net interest on obligation, beginning DBO times discount rate equals interest expense. Net interest on assets, beginning plan assets times discount rate equals interest income. Net interest cost equals interest expense minus interest income. Net interest on net liability equals beginning DBO minus beginning plan assets times discount rate. A. Incorrect. Actuarial losses from discount rate changes are classified as remeasurements. Remeasurements are recognized in OCI, not profit or loss. This includes changes in any actuarial assumptions: discount rates, mortality rates, salary growth, turnover. Include the difference between actual return on plan assets and the interest income component. Recognized immediately in OCI and never recycled, amortized to profit or loss under IFRS. C. Incorrect. Under IFRS, there is no expected return concept for profit or loss purposes. The return included in profit or loss is the interest income, based on the discount rate. Actual return on plan assets may differ from this interest income amount. The difference between actual return and interest income is a remeasurement component. This difference goes to OCI, not profit or loss. Interest income in P&L equals beginning plan assets times discount rate. Actual return equals market gains or losses on plan assets during the period. Return on plan assets equals actual return minus interest income. This difference captures asset performance above or below the discount rate. Keeping this in OCI prevents investment volatility from affecting reported earnings. IFRS uses discount rate for expected return component. Differences go to OCI and stay there. US GAAP uses expected rate of return, often higher than discount rate. Remeasurements go to OCI but are amortized back to P&L over time. IFRS approach is simpler. Remeasurements never flow through to profit or loss. US GAAP uses more smoothing, eventual amortization of remeasurements to P&L. A company is deciding between granting restricted stock units, RSUs, or at-the-money stock options to its employees. A key difference in the accounting for these two instruments at the grant date is that A. The RSUs will result in a higher total compensation expense because they always have intrinsic value, while options may not. B. The fair value of the RSUs is objectively known, while the fair value of the options must be subjectively estimated using a valuation model. C. The compensation expense for the RSUs is recognized immediately, while the expense for the options is recognized over the vesting period. Correct answer, B. RSUs. The fair value of RSUs is based on the market price of the underlying stock at the grant date. This value is objective and easily observable, as it directly reflects the current stock price. Stock options. The fair value of at-the-money stock options must be estimated using a valuation model, such as Black-Scholes or binomial. These models require subjective inputs such as volatility, time to expiration, risk-free interest rates, and dividend yields. The lack of intrinsic value at the grant date, since the exercise price equals the market price, means the value comes entirely from time value, which must be modeled. The primary accounting difference at the grant date lies in how the fair value is determined, objectively for RSUs versus subjectively for options. A. Incorrect. RSUs. While RSUs always have some value, as long as the stock price is above zero, the total compensation expense is not inherently higher than for options. The expense depends on the number of units granted and their fair value. Stock options. Options can have a higher estimated fair value than RSUs due to their leverage and time value. For example, if the stock price is expected to be volatile, the options value, estimated using a model, could exceed the value of an equivalent number of RSUs. This is about ultimate expense amount. C. Incorrect. RSUs. Compensation expense for RSUs is not recognized immediately. Instead, it is allocated systematically over the vesting period, usually on a straight-line basis as employees provide service to earn the award. Stock options. Similarly, the expense for stock options is recognized over the vesting period, not at the grant date. Immediate recognition would be inappropriate because the employee has not yet earned the award. The timing of expense recognition is the same for both RSUs and options. The difference lies in the initial measurement of fair value, not the recognition period. Stock options create an asymmetrical payoff for managers. Unlimited upside. If risky decisions lead to a sharp increase in stock price, managers can exercise options at the low strike price and sell at the high market price, realizing large profits. Limited downside. If risky decisions fail and the stock price falls below the strike price, the options become worthless, but the manager loses nothing beyond the unexercised options. This structure encourages managers to take excessive risks, as the potential personal gain outweighs the potential loss. This explains why stock options might incentivize risky behavior, but it is unrelated to the accounting differences in the question. An analyst collects the following data in $millions for a company reporting under U.S. GAAP. Contribution to a defined contribution plan $800. Service cost for the defined benefit plan $1,200. Interest cost on the projected benefit obligation $350. Expected return on defined benefit plan assets $600. Amortization of prior service cost $150. The total pension expense in $millions the company will report on its income statement is closest to $1,750. B. $1,900. C. $2,450. Correct answer, B. Includes both parts, the defined contribution expense, $800, and the net periodic pension cost, $1,100. Net periodic pension cost is correctly calculated as service cost plus interest cost plus amortization, minus expected return. Shows the proper U.S. GAAP treatment. Contribution recognized immediately. Defined benefit expense built from multiple components. Why $1,750 million is incorrect. This figure comes from leaving out the amortization of prior service cost, $150. It demonstrates how easy it is to miss one component of the net periodic pension cost. The omission highlights the importance of recognizing amortization from OCI into P&L. Why $2,450 million is incorrect. This results from mistakenly adding the expected return on plan assets instead of subtracting it. Under U.S. GAAP, expected return reduces expense because plan assets generate income. Misinterpreting this flips the effect, inflating the expense by $600. Define contribution plans. Expense equals the cash contribution, no complexity. Define benefit plans. Expense is multi-component, requiring careful inclusion of service cost, interest cost, amortization, and expected return. Expected return always reduces expense, not increases it. Amortization of prior service cost must be included, as it shifts from OCI into the income statement.